A topic I think that is totally top of mind for many of us, especially as we're in the midst of tax season. So today we're covering topics such as individual and corporate credits, smart giving tools, strategies to reduce taxes and protect investments, and using the tax code to maximize impact at every stage of life. I will turn it over to Chris, who is our first presenter.
Good morning, everyone. I'm so glad you're here, and we're talking about something that hopefully people have heard of. What we find in our practice is that many people don't know about the Arizona tax credit. So, unfortunately, we find more people don't know about it than do know about it, but that's what we're trying to educate people to do. Is to use the Arizona tax credit, which benefits both a wide variety of nonprofit organizations, but also can benefit um, a taxpayer who either wants to, if they have the right entity structure, pay their tax through the tax credit. Or if you are filing your own personal return and you owe Arizona state taxes, then depending on how much you owe, if you are charitably inclined, then donating that to the state is a dollar for dollar deduction to your personal tax liability. And I'll kind of go over both what those look like. And I really chose today to focus on one, which is what the individuals can do, and then one, which is S Corp owners can do, which is a slightly different mechanism, but still achieves a goal for business owners. So if you have an S Corp and you have personal tax liability with the state of Arizona that is either not satisfied by your withholding or any other mechanism, then using the STO credit is a great way to expense your Arizona tax liability through your business. So how that works is that it's the school tuition organization, and so for the pass-through credit, you would be donating to a for educational purposes, a school tuition is basically what you're going to do. And how that works is that the state has so much funding for this program every year. And then when the funding is done, then you cannot submit for that tax credit. I will say that most years that is not an issue. Most people do not participate sufficiently where the amount that the state funds for this is met. But it's always good to do this early if you want to do this particular pass through. So if you have an S corp, what happens is you pay 2.5% of your gross income to the state. You do that as an expense. That the minimum donation for that is $5,000. So this would be for taxpayers who on their personal tax return owe more than $5,000 to the state of Arizona. That's where the money really makes sense. You make it from the business, and then the credit passes through on the K1 that your business produces for S Corps to your personal return. So it's a great way for people who have a lot of tax that they have to pay to then pay that tax as a business expense. There's not really a lot of mechanisms in tax structure that allow you to do that. Charitable giving, for example, usually in an S Corp, there's no deduction at all on the business side. It flows through to the personal tax return. So this is a great opportunity for people who owe tax of a substantive amount to be able to expense the payment of that through their S Corp. So the payment, or it's really a donation, has to be made by December 31st of every year. And it's a pretty straightforward process. There's a website that we can link to. And of course, it's something that Numbers Matter does and can help clients with that as well. The other tax credit that's really more, I think, if you're familiar at all with the Arizona tax credit, this is the one that more people are familiar with. And so what happens here is if you have an individual tax liability for Arizona on your personal tax return, you can either pay the state that amount Or you can choose, there's really five of these. I don't know why they don't make the fifth one more prevalent, which is for veterans. But whether you're a single filer or married filing jointly gives you the constraint per category of how much you can use for the Arizona tax credit. So in some cases, we encounter clients, what we do is, my ideal tax return is that clients don't get a refund and they don't have to pay in. And it's really hard to get to that number, but we do actually a really good job with that. And so yesterday, for example, we had two clients who strangely have S Corps, but they owed less than $100 on their personal tax returns to the state of Arizona. One owed $58 and one owed $79. And I said, well, we can pay that, to the state, or you can choose one of these four options for charitable giving. And you do have to, you can't just choose who you want to, like you can't donate to your local church or some nonprofit that you love if it's not a participant in the AZ tax credit. And there's a great website that they put together, aztaxcredits.com. And we have a relationship with them just in the fact that if a client of ours uses their page they made for us, then we get the paperwork automatically. But anybody can use that website. That doesn't, because we have a reporting relationship with them, doesn't make it any, different or special. So in the case of those two taxpayers yesterday, one just made a $79 donation to an animal, behavioral animal agency, and then the other one did theirs to some other nonprofit. So you have these choices here, which are presented on the screen as a single person or married filing jointly. You have different rates, but there are four different types of credit. One is the qualifying charity, a QCO. So for theirs, there's a whole list at their website. You can go through them and pick whichever one you want to use. The other is foster care. The third one is private school. The fourth one is public school. And those are basically, listed here in a sense, but the one that doesn't seem to get as much attention is the military family relief. It's also a small amount. So when we start at the top for 2026, the qualifying charity donation is either as a single person, $506 for 2026, or 1,009 for married filing joint. For foster care, the numbers are 632 and 1262 for this coming year. Private school, public school, military family relief. The military family relief is small. It's only $200 for single or $400 for a couple for a joint return. So what happens is you can go to the website and then make those charitable donations. You have to provide your tax preparer that information. And so if your tax preparer does not have a relationship like we do with the Arizona tax credit to get that information automatically, then whatever you do on that website, you just need to provide your tax preparer the information. So for example, if you chose a charity out of the QCO list, and you paid the $79, then you just let your taxpayer know, hey, I did this Arizona tax credit. Here's where I donated it, and here's the amount and the date. The date is reported on the tax form. So once that's entered onto your tax form, then whatever you owed to the state of Arizona is reduced dollar for dollar by that amount. Many clients, because of the total of what you can do on the Arizona tax credit, will not pay the state of Arizona and instead will fully take their liability through the Arizona tax credit so that they're not making any payment to the state. So if you're charitably inclined, especially, and donate to charities regularly anyway, this is a really great option to get a tax benefit that's really immediate to do so. When we think about other types of charitable giving, let's just say you wanted to give $10,000 to some nonprofit that's not part of the Arizona tax credit, that may or may not actually make much of a difference on your tax return because the standard deduction is so high. Itemized deductions, which is where normal charitable giving would fall into, has to be a really large number. So for example, 25, 26 years, 25, 26, you're right around 31,500 if you're marrying filing jointly, which means that the total of your itemized deductions, including charitable giving, has to exceed that amount in order for it to really be impactful on your tax return. And so if you donate that 10,000 in that example, it may or may not be even be reported in a sense on your tax return and really may or may not benefit you in any sort of way. Here, these tax credits really do benefit you individually because you can reduce your tax liability in a way that making a large charitable donation sometimes cannot do, just depending on your tax structure. So this is really more of a great tool to use if you are charitably inclined and want to do that. Of course, if you're not charitably inclined and you'd rather just pay the state of Arizona, that's what most people do. And so I'm really happy that we were able to talk about the Arizona tax credit today. I know that the S Corp side of that can be a little overwhelming and a little confusing. Happy to provide more guidance on that. For the individual filers, it's really easy to do at the AZ tax credit website. So it really does help a lot of agencies in the state of Arizona that wouldn't probably receive as much funding as they would otherwise.
Thank you, Chris. All right. A reminder, please feel free to drop questions in the chat, and Chris will be able to answer them when we get towards the end of the webinar. Right now, we're going to transition over to Catherine, who will share a little bit more about some investment strategies to preserve wealth and also do good for the community. Catherine, would you like to introduce yourself?
So happy to be here. Thank you. My name is Catherine Scribano. I'm the founder and principal at Castle Financial Group, and we are a financial planning. So we work with families and small businesses to help them identify long-term goals and figure out strategies to reach them. One of the most rewarding parts of financial planning is talking about charitable giving. It allows people to support causes that they care about and potentially getting some tax benefits at the same time. So there's several ways to structure charitable giving, and some of them take place during their lifetime. Sometimes that happens through your estate. And I thought I would just hit quite a bit at very high level some of the strategies and techniques that you use with the encouragement to have you work with a professional to implement most of these. Some of them there's a lot of moving parts to make them work accurately. The first one that I thought I would mention is giving to your estate. This is probably the simplest way, just an outright request in your will or your trust for the name of charity. You can name a specific dollar amount or perhaps the percentage of the estate or maybe a particular asset. And I'll talk about that in more detail in a minute. But this is real straightforward and it can allow you to make a remunerative gift without affecting your current finances. These are dollars going to the charity after you pass. A real effective technique for leaving money to a charity is using their retirement accounts. If you leave money to an individual, they're going to pay tax and not insignificant taxes on that money that they want to withdraw from the retirement account. And there are a lot of forced distributions rules, especially for non-spouse beneficiaries, that may produce more income tax liability than is comfortable, but there's just no getting around it. If you're charitably inclined, leaving your IRA assets or your 401k, those kinds of tax qualified plans, meaning the charity as a beneficiary, maybe even just a partial beneficiary. That can be very tax efficient because remember the charity does not pay tax. So if you have a choice between qualified accounts and non-qualified accounts in the beneficiary, naming that the charity is a beneficiary, we generally look to be qualified, the IRAs, 401ks, or COLA plans. That means they usually look to those to be the first source of the contribution. More advanced strategies include charitable trusts. A lot of people really love to do this structured giving, and these are nice because they could potentially provide income to you now during your lifetime. And then ultimately, when you pass, charity receives proceeds. They tend to be kind of complex to be qualified, make them work the way that you want to. So be sure that you're using the assistance of a legal and financial professional in designing these. But it's a great opportunity to do good and do well at the same time. You talk to clients a lot about what are the best assets to donate. Again, from a tax perspective, if you itemize deductions, maybe your charitable contributions will provide a tax benefit. But as Chris mentioned, the standard deduction being so high, many people don't itemize. And it makes more sense to just donate appreciated assets, those that are worth more than you paid for them, and donate those directly to the charity. So an example of a highly appreciated asset might be stocks, real estate, artwork that has been appraised, rather than selling the asset, paying the tax, and then donating the remainder to the charity. You can donate the asset itself to the charity. They can sell it and keep 100% of the proceeds. You do need to touch base with the charity before implementing this strategy to make sure that they're able to accept what you're hoping to donate to them. Most have a gift acceptance policy, and they may eliminate some things where they just simply can't convert those to cash, or they don't want to take on potential liabilities. So make sure that you check with the charity and say, this is what I'm thinking, can you accept it? Assuming the answer is yes, this is a terrific way to fulfill your charitable intent without creating a bad stuff. Another thing that we have seen is people take income producing property. Maybe it's real estate or dividend paying securities that are creating a tax burden for the client. If they're charitable inclined, those are great candidates for a contribution. Again, making sure that the charity can accept it, but having those properties or securities transferred to the charity, fulfilling your charitable goal and saving taxes as well. And also tangible personal property, things like vehicles, jewelries, collectibles, artwork, those kinds of things are often very smart charitable contributions. I'm going to write a book at some point that says your kids don't want stuff, but if you've got stuff and there is value that can be established through appraisal, the kids don't want it, give it to your favorite charity and let them sell it or find ways to use it to support the good work that they do. A common and very simple way to make a meaningful legacy gift is using life insurance. This can be a way to make the beneficiary of the life insurance policy, your favorite charity, you're making small, generally payments in comparison to the gift, and then at your death, the charity receives the death benefit, the proceeds of the life insurance policy. There's also more advanced strategies using life insurance that can provide some estate planning benefits. If you have a taxable estate that's more than $15 million for an individual, 30 million for a married couple, sometimes life insurance that benefits a charity can make a real significant impact on the estate reducing the estate tax purposes. But again, this is a little bit more sophisticated strategy You want to make sure that you have qualified professionals on board as you go through this. By qualified professionals, I mean someone other than the insurance representative, the person selling you the policy. No disrespect to them, but they may very well not be qualified in the larger strategy. So be sure you get the right people on board in this plan. Are meeting more and more people who love the idea of a donor advised fund. And this is your chance to almost create your own foundation without the restrictions and the reporting requirements of the foundation that were just so onerous. So you're contributing assets to the fund. You generally get an immediate charitable tax deduction. Then the funds are invested and you can recommend grants to charities over time. These are generally established at community foundations or trust companies. So you do have to have a custodian that is monitoring and making sure that the compliance is there. But this is a terrific way for you to make a meaningful impact and stay involved, especially over a long period of time. It's very satisfying. Again, similar to a private foundation, but a lot less administrative work and expense. And I'm going to end with my favorite because I realize this is so underutilized. As Chris was talking about some of the strategies that he did, it's frustrating to see people complain about their taxes, their tax burden, and leave aside some of the opportunities to do good work and benefit tax-wise as well. The charitable qualified distributions from your IRA. And keep in mind, please, this only applies to IRAs. It does not apply to 401ks or other employer plans. But you can take those dollars, roll them into an IRA, and then make qualified charitable distributions if you like. This applies to people who are over age 70 and a half. And a lot of people, believe it or not, sometimes when we're in our accumulation years, we're surprised to even think that there might be a time when you don't want to be forced to draw money. But in fact, many people do get to a point where they've got money in IRAs, and Uncle Sam says you can't have the tax benefits of deferral of taxes last indefinitely. At some point, you have to start taking money out. Depending on the year of your birth, that could be anywhere from age 70 to 75. But as you are required to take money out, one of the opportunities you have is to direct those distributions to the charity. And it must be direct to the charity. You can't take custody of it. You put it in your bank account, then write a check and send it to the charity. This strategy won't work. But if you send it directly from your IRA to the charity, up to $111,000 per year can be completely excluded from your taxable income. So it's as if you had never received it. You won't pay tax on it, but you can continue to support the good work of the charities that you're interested in. So again, you have to be age 70 and a half or older in the year that you're making that distribution. If you have to take required minimum distributions, this could be part of that satisfaction. You don't get a charitable deduction, but expanding the income is generally more valuable than a deduction. So again, sending the money directly to the charity, and you cannot make those deductions, or I'm sorry, these contributions to donor advised funds. I mentioned those earlier. Private foundations also are not qualified, so you have to send them directly to the charity. But it's a pretty underutilized technique and such a wonderful way to, again, do well while doing good, avoid paying taxes and supporting the charities that are doing such good work in our community. So charitable giving is really most effective when it's integrated into a broader financial and estate plan. So we encourage you to be thinking about what are your goals, what do you own, and what are the causes that are important to you, and then integrating all of those things into an efficient plan saving you some taxes and enjoying the good work that is being done all around us. And that's it. There's kind of high level. Happy to talk about more detail. If anyone would like to kind of think through and talk through whether these ideas apply to you, there's no obligation. Just give us a call. We're happy to do that.
Awesome. Thank you. Now there's time for questions. If you have any questions, you're welcome to come off mute and ask, or you can drop them in the chat and we'll hang around for a few more minutes. And then also, we've included the contact information for Chris and Catherine. If you have something a little more specific or personal, or you just want to explore what services they offer and learn a little bit more about their businesses and how they can serve you in your business. And as well, my contact information is listed on the screen too. And a QR link. Local First Arizona is a 501(c)(3) charity and also a qualified charitable organization, as Chris was referring to earlier in the conversation. So we are an organization that is eligible for the Arizona tax credit if you were to make a contribution to us. So we've included a QR code on our page that you can scan or visit our website. Do we have any questions today? Well, we were not only tax efficient in this conversation, but apparently we were efficient in the content. So, um, again, any questions, please feel free to reach out to our two wonderful presenters. Chris, thank you so much for everything that you shared. Catherine, thank you as well. It was wonderful spending time with you all, and we look forward to connecting with everyone soon. Again, this was recorded and will be sent out after today.